So let's talk about your investing style, right? If it was a sport, which one would it be and why?
Tennis would be baseline player. You keep returning the shots. When you find playing, you try and place it well. But yeah, at times you will have to do serve and volley and come and be a bit more aggressive about taking the opportunity when you have to. But most of the time, I think a baseline clay court, Ivan Lendl types would my style, yes.
Welcome to Get Real About Wealth, a new podcast brought to you by IndusInd Bank. I'm your host, Sonia Shenoy. Now, when it comes to managing wealth and building sustainable businesses, few people have as much experience and insight as today's guest. I'm thrilled to welcome Vishal Kapoor, the CEO of Bandhan AMC. With nearly 3 decades in the financial services industry, Vishal has built a reputation for driving innovation and expanding financial services into new markets. So today we're going to dive into his leadership journey, how he's navigated market shifts, and of course talking about how he's built wealth. Vishal, welcome to the show.
Thank you firstly for having me and for such a generous welcome. Thank you.
Okay, so Vishal, 3 decades of being in this industry. Tell us a little bit about your own personal journey. I mean, were you introduced to money by your parents, or did you have any other kind of mentor because of which you started investing?
No, quite the contrary. I think I grew up in an environment which was very engineering dominated. My dad, his friends, my elder brother and his friends were all engineers. But I think it was the time.
So you were the black sheep.
I was the black sheep, yes, confess to that. So the late 80s, early 90s, the stock markets were sort of getting very active.
Correct.
A lot of money could be made, and I sort of got drawn into that, saying, look, there is a lot of wealth that can be created. Two, in the early 90s, you remember that the liberalization was taking place, and I think that changed quite a few things. So instead of pursuing science, which I did till +2, I moved to finance and economics and said, okay, that's where I want to actually spend a lot more attention now. And I started investing a bit in college, and then, through MBA, it was not investing, but at least tracking the markets. And that got me into my first job, which was in the area of mutual funds, and then continued since then.
Nice. So it's been a long journey for you. But I think the last 4-5 years have been phenomenal, right, for the stock markets. Since 2020, I think we haven't seen any major correction. But for people who are perhaps entering now or still want to continue that wealth creation journey, what's the best way to approach the entire equity market space?
So, to me, Sonia, the principles haven't changed. And I think too many of us try and outguess the market, or just look at the levels a lot more carefully than what is my objective. And why I'm saying that is because through behavior and through data, we saw that after the COVID fall, not everyone got into the correction, and too many of us maybe exited then and said, oh, I'll wait for the right level and then I will come in, and then you pretty much missed a large part of this rally. So not everyone participated wholeheartedly. And the same thing could happen if you're starting now and looking at maybe the next 20, 30 years. So it's really, what are you looking to do? And if you're investing because you're looking at a long-term wealth creation opportunity where equity is a large component, whether the market is 1,000 points above or below where we are today, will that really matter 20 years later, right? The larger part of what I would offer will matter is how much of this, which is what is the allocation to that asset class. And that will define whether you actually benefited from this opportunity or you are suboptimal in how you approach this and trying to time it too carefully.
If you look at India, I mean, we were talking about this earlier, we have just 5 crore unique investors compared to a population of over 140 crore. So do you think the major part of penetration in the next 10-15 years will come largely from rural and semi-urban?
I would say that there's opportunity everywhere. And, 2-3 shifts may happen in any case, because keep in mind, people in rural, semi-urban are moving to urban centers as well. So that's one thematic that we will see. And, frankly, for us as an industry, it's about accessing them, sharing information, providing them the opportunity to invest. Whether they're in a tier 4 city or tier 2 city, that really doesn't matter. I would also argue that even in Mumbai and Delhi and Chennai and Bangalore, have we saturated the market? Not really. So there is opportunity everywhere. Now, clearly on a smaller base, the B30 towns are growing faster because naturally there is a catch up and there is more access information technology that allows me to access funds which I could not do 10 years back. So clearly there is a faster growth that we are seeing there, and we want to participate in that as well. But that doesn't mean that growth will not happen in the cities or in the tier 2 towns, because as people move, it's really where is your youth moving, where is the savings happening, and can we be there to be able to help them participate in the capital markets as well.
You have so much experience, and there is this new generation who's not even seen a bear market, not even seen one bear market yet, right? So perhaps they have a lot of turmoil that they're going to see in their portfolios. What is your advice from your own personal journey of wealth creation? What is your advice to new and young investors? From the mistakes that you made, what would you want them to avoid, and what's the best way to approach it?
So one, I think it's maybe important to make those mistakes. I made mine. So starting out early, I thought, yes, I can be a great stock picker. And when the F&O market opened up, it was not always there. So I predate that. You wanted to try out a few option strategies, etc. And then you realize, look, this is just taking too much energy and the payoffs are just not enough. And like I said, it's not sustainable, so it's not going to work. Having worked with a lot of clients and customers and then seen a lot of data in my various hats, I have come to the belief that, wealth creation is a process. And some of the very old classic principles are still very true. It's like, Newton's laws. It's like, do a few of these things and you should get it right, largely. Maybe it's not as scientific in a sense, but I think at least illustratively, most people seem to at least make money out of following a few of these. The first one would be, I would say, you should have a goal or a purpose, provided you have savings first. So let's start at the point zero. First, save. Don't spend it all. Don't live on credit. If you've got savings, you've got something to work on. Once you've got savings, try and put a purpose. It'll help you in your journey of saying, what is this money for? What is it meant to do? And that will define what your allocation should be. And that's the important
So how
point.
much should your savings be before you start your investment journey? I mean, how much should you keep in your emergency corpus? How did you go about it?
So yeah, you need to be able to cover your monthly expenses for at least a few months, and 3 to 6 months is what most people will advise. So yeah, 3 to 6 months of emergency corpus or expenses should something happen to your job or an emergency, that's required. But beyond that, I think you should be able to invest. Also, when you invest, not everything is locked away. So, you have very good investment options today where money comes back to you in just 2-3 days. So, you can use that as well for your emergency corpus, which is also a bit of an investment. It's not giving you a lot of growth, but it's still a good enough way for you to try and at least match inflation, if not beat it significantly. But then you've got to look at allocation, which is how much in which asset. It's important because you have to have growth in your portfolio. Because wealth gets generated over a long time because you're able to beat inflation consistently after tax. And that's what leads to the magic of compounding over a long period of time. If you can just take these 2 or 3 steps and be at it very, very consistently, I would wager that there is a very high probability that you will end up with a number you haven't imagined today.
Wow. So what is your own asset allocation strategy? How much of your personal wealth is in equities? How much in real estate? If you can just help us understand, what is the path that you've taken?
Yeah. So I may not be the best investor or the customer, because keep in mind, I work in a very highly regulated industry, and therefore we follow very strict do's and don'ts. So stock portfolios are out. Real estate I don't believe in, except for a house that you want to live in. So most of my money is in funds, and where possible I choose my own funds. My allocation strategy is very, very classic, which is that you keep some money for emergencies. The balance I keep a growth-oriented, growth-dominated portfolio, which is largely equities, some amount of fixed income. Within equities, again, I have a broad basket. So it's a multi-cap strategy across different ideas, which is again on a buy and hold. I try and match my cash flows within investments, so I keep it lying in a bank account. So SIPs into a couple of funds which can meet your asset allocation need, to me, is the simplest, most effective way to go about it.
Okay. So there's this big discussion about building wealth, but at the same time living your life, right? And spending your money on experiences. What is the most important lesson that you've learned on how to balance these two?
So I think, look,
Assuming that you've already struck a balance.
no, I haven't. So I was about to say that, we're presupposing I know it. I don't. But the way I think about it is that these are not extremes for us to try and, get to. One argument has been that money cannot make you happy, which is true. But, try being happy on an empty stomach is the other argument. It's very difficult. Can money buy you happiness? It can't buy you happiness, but it has its utility. And I think my learning has been, and, growing up, there was this belief that, money is the root of all evil. And somehow, the jamindar or the rich person in the movie is always the evil guy, and the poor middle class or the mill worker was always the honest guy, which we have to challenge. Look, is that really true? Because a lot of research is showing us that money does lead you to a much more fulfilling life. Why? Because one, you get a lot more time, which is a luxury. You can do things that you can otherwise not do if you have a 16-hour work schedule that you can't get out of. You can give it away, which is a huge amount of joy, right? You have a lot of flexibility, with what you want to do. You can afford to fail, which you can't otherwise. So there are so many degrees of freedom that money and wealth gives you. And I would say, therefore, for someone to say, look, I really don't want any money or wealth, I say, look, think again. Let's be real. It can deliver a lot better quality of life, and you don't have to give it away when it's actually well within your reach.
No, I absolutely agree. I mean, I believe that money buys you a lot of happiness in different ways, right? The ways that you mentioned as well. But what is the most unconventional investment decision that you've made, either personally or professionally?
Okay, unconventional. I would say it. Investing in yourself, if that can be called unconventional. Taking some time off to rejuvenate. I did a meditation course, for example. It means time out of work and going out and investing in about yourself, thinking about things, experiences that you can get. So these are all, I would say, still part of an asset pool that you should be trying to create, not just your bank balance or your wealth statement, which is telling you how you lived your life.
Okay, meditation, that's interesting. So are you does spirituality or meditation help you when it comes to investing? Because investing is also a lot about fear and greed. And do you manage your emotions through meditation?
I'm exploring still, but I do think it helps. So the more I explore the subject, I do think it has very, very powerful properties or qualities that one can use in everyday life. So yes, absolutely, it's an area I would like to pursue further. I can't say I've reached an area where I can say yes or no, but definitely well worth it.
So let's talk about your investing style, right? I mean, if it was a sport, which one would it be and why?
My style, if I think about tennis, would be baseline player. You keep returning the shots. When you find an opening, you try and place it well. But yeah, at times you will have to do a serve and volley and, come and be a bit more aggressive about taking the opportunity when you have to. But most of the time, I think a baseline, clay court, Ivan Lendl types would be my style, yes.
Okay, but in the traditional way, are you like a value investor? Are you largely a risk taker? What is it that is your approach?
So my approach is leave it to the experts. I don't look at that at all.
Okay.
My approach is you focus on the allocation because that to me is what will matter. So if I pick up, as an example, 75% of my money should be in growth-oriented equity stocks, let's say. You have to diversify across styles, across segments, and let the experts do the job. I won't be able to get it right. And, saying, okay, so much should be value and so much would be momentum, etc., it'll go through cycles.
Correct.
Now, if you're investing for 15, 20, 25 years, it'll even out. And there is no crystal ball that I will have better information than the expert to be able to
absolutely.
manage it day to day. So leave it to the experts. Focus on the allocation. Focus on getting the simple things right, which is where I think most often all of us make a mistake.
Correct. Has there ever been a conflict between your personal and professional financial strategies? And if yes, how have you sort of navigated that?
So for me and largely for our community, I think professional has to win over personal. We may come across a lot of information, but clearly you cannot use it for personal strategies. So it has to be, therefore, no conflict because personal has to be regulated, almost controlled. And there are ways, like I mentioned, we don't buy stocks, we don't do any F&O, we don't do any exotic things. It is largely third party managed, and that's a very safe way, easy way to manage the conflict.
So, in your own personal finance journey, what has the most challenging investment decision been for you, and how has that changed your perspective on wealth?
Yeah, so the one that I mentioned around taking a loan. So this was second year of college, and my dad was supporting my fees. And the MBA school I was in suddenly, really hiked up the fee for the year two. Because the grants had changed from the government, etc., etc. And suddenly someone came to campus saying, do you want a loan? Now that's not something you had thought about till then. But that puts up a dilemma, how much of my dad's money should I use and how much of my own should I actually use for this? I ended up taking that loan after really debating that question a lot. And when I look back, I think it was great that I did, because a loan teaches you a lot about repayment, and it also makes you a lot more responsible about money. So till that time, you were always on your parents' money. You were being frugal, you were being responsible about how you spend it, but it was still their money. And for the first time, it's money that you drew from an account and you have to pay back. So I think the first and early money lessons can be very, very helpful in shaping your thinking around how to work with money.
Correct. So taking a loan, that shaped your, your, I think, viewpoint on money and how to move forward. But any other stories where a personal finance decision has impacted either your view on money or your view on success?
So view on money, I think, in school I used to do a fair bit of community service, because we were living in an area which was surrounded by a lot of small villages. And when you go into a small village, and this is rural Bengal, you suddenly realize how valuable a 50 rupee note or a 100 rupee note is. Sometimes in cities and sometimes in protected environments, we forget that.
Yeah.
And I remember going to a village where the monthly expense of running a clinic, which was the only clinic, a health facility for a very large area, was like 100 rupees. And you realize, oh my God, 100 rupees can serve a community for 1 month of medical supplies. And so the learning is really money is important. Don't disregard it because you're a bit snobbish about I'm into other stuff and money doesn't matter. It is important. So that's one learning. Second learning is it's never going to be enough. In my career, I've worked with people who are really rich, really, really rich. Because in the wealth industry, you come across very, very successful people, especially in terms of money. But they're still chasing something. And you come across people who are really modest, but who are absolutely chilled out. So it's also a state of mind. The account or the balance is really not going to define how wealthy you are. It's your state of mind beyond a point.
Absolutely. And this chase, right? I mean, this hustle that we talk about, a lot of young people are facing the pressure right now. There is no work-life balance in most organizations, and we keep hearing about incidents as to how it's taking a toll on young people. How do you manage? I mean, you've been doing this consistently for 30 years. How do you take the pressure off?
So one, look, there's no mantra per se, but I would say that even if you can't love what you do, at least like what you do. If you hate what you do, why are you there? I'm sure you can try and figure something else out. So at least like what you do. And once you're in it, I would say, you have to draw some boundaries around, how much work, how much, for yourself. Because if you're not doing that, it won't sustain. And if it's not going to sustain, it'll end up not looking good, as unfortunately we've seen in a few cases. So it'll go back to a few of these. I think a friend circle, a social circle, a relative network, whatever, it can be a great way to manage this, apart from whatever you can do yourself, to sort of, entertain yourself, get some time off, etc. But I think a social network is very important that way.
Okay, a social network is important, but when you take time off, What is it that you do? I mean, what have you developed any hobbies? Because I hear this a lot about people from the industry. They spend so much of their younger life working that they don't really cultivate as many hobbies or any passion. Now things are, of course, changing. But I mean, what do you do in your spare time?
So I try out a lot of things, to be honest.
Okay.
So I'm a classic, master of none. I just move from one to the other. So from sports to running for some time, and then now a bit of a fitness regime. So you really not you have the energy to sort of give your best, to try and give your best every day at work. I think that's one. Meditation, like I mentioned, is something that I'm trying out, a bit of spirituality, and I find it fascinating as a subject. And entertainment, I think, all the stuff that everyone does, which is whether it's theater or movies or, or music, so all of that is there. I love traveling. I think I love exploring new
Universal
places.
passion everyone has.
Absolutely. So if, every couple of months, even if it's a weekend, you can, head out and, explore and outdoor really rejuvenates me. So if a couple of weekends out every few months, I think that does a lot for me.
So, any interesting books that you've read along the way in wealth management, money management, psychology of money that you'd want to share?
Quite a few, and I think interesting is a good word, because these tend to be heavy, as you might imagine, but I find it fascinating because sometimes you find that the core principles are the same, but the way different authors, different experts interpret it is just fascinating. Same subject, but such variety in a sense. There are the classics that I think everyone's heard of. But more recently, I think clearly Psychology of Money, you mentioned, it is a book that you should go through. I think Morgan Housel just make it so palatable for most who are not into finance in a sense.
Correct.
But there are numerous examples. I would also say that some of the newsletters, including Warren Buffett's annual shareholder letter, can be a treasure trove. And for someone who wants to understand how investors think, that can be also a very insightful way to look at money management if you want to become an expert.
Okay, and if you had to design a course on leadership or on wealth management, right, for high school students, because a lot of people talk about how now personal finance education needs to be imparted, especially to the younger generation. What are the 3 or 4 lessons that you would make sure that children learn about money management?
First would be save, so spend less than what you earn. That's an important point we shouldn't take for granted, because now when you look at sometimes the credit data coming through, that shouldn't be lost. So first you must have savings to get started into the world of investing. As you begin your investment journey, you can just get started and say, let me try and grow it as quickly as possible. That's one approach, nothing wrong in that. But I find that attaching a goal to different pots of money can help clarify your thoughts. So have a goal, even if it is, 2 years later I want to buy something, or 5 years later I want to do this with, something with it, because it will help you be very clear about what you're doing. Sometimes I find that people overcomplicate the journey, because you're trying out too many things, or you're trying to do too many things simultaneously. So I would say, I at least personally follow that, keep it simple. Because beyond a point, you come across portfolios which have got 100 funds. How are you going to manage that? And you have to appreciate the power of compounding. Sometimes, and we've done these exercises at schools and, different forums, etc. We will get it wrong when I ask you that, try and project the value of this money compounded over 20, 30 years. We will always be short on what that value will be, because we underappreciate the power of compounding. So if you can just get that one thing right, do the math once, see for yourself, and then start on that journey, I don't think you will need anything more to really get on that path.
Okay, and are there any unconventional sources of knowledge, learning, or inspiration that has shaped your own personal thinking about wealth?
Unconventional. So look, both in college and early part of life in Mumbai, we used to travel in local trains. And I think that's a great, rich source of a lot of, wisdom, if I
Really?
can call it that. So try, going on a local train, at least in the days when I used to be a frequent, you would have these groups of people. There's a broker group and there's an industrialist group, and there is, so you get a lot of perspective on industry just standing in for a 35-minute journey. And there is just so much out there. So it doesn't have to be a book. It doesn't have to be a source of formal media. I think that's to me a great way of understanding what's really going on, because I think perspective, often differing perspective, can help you just understand how the same thing can be looked at so differently.
Let's talk about life beyond financial success, right? Because everyone who sits on this chair, we assume is financially successful. But what does success mean to you beyond finance?
So one, you're assuming I'm financially successful. I don't know. But success to me is really, a good life without too many regrets. So I would define success more in the sense of, memories you cherish, essentially. Whether it's a career, whether it's your family life, or whether it's your friends, etc. So I think, money has a role, and like we discussed, it's not important. It's very important. But it also has a diminishing marginal utility. Beyond a point, it is not as important. So your first 100 is very important, and the next 100 is less important, and there you go. So beyond a point, it's not going to define you. What defines you is a lot more than that. And I would say that not having too many regrets, being able to explore things, learn a lot of things, and eventually ending up with a bank of great memories that you can cherish is probably a good way for me to define success.
And what has been the biggest challenge for you in balancing your personal and professional growth? And how did you sort of overcome that?
So still trying. I don't think I've achieved, a state that I'm happy with, because I'm still pushing myself to do more at work, because there's so much to be done. There's just so many exciting opportunities at work. Yet on the other side, there's so much to do personally as well. So I think bringing more efficiency into both ends is a continuous process, and that's what I'm trying to do.
So, younger people are talking more and more about retirement now than ever before, right? Financial independence, retire early, that's the buzzword. What are your thoughts about that?
Financial independence, absolute thumbs up. Retire early, I would say, really, for what? And what does retirement really mean? So if retirement means you don't have to rely on income, okay, got it. That's fine. That's great. But do you really want to retire from life? Aren't you throwing it away then? So I don't want to retire. Now, what you choose to do is a different thing. So I guess what people mean is I want enough money so that I don't have to do a day job.
Correct.
Right? So
And you can do what you love. Yeah.
Yeah, but if you can align that love with as close to possible with your day job, that would be a good starting point. And second is, I think, financial independence will mean different things to different people. It's very difficult for you to reach a stage and say, oh, that's it. So be very careful about that, because it'll inflate. Getting out of college, we thought a certain number we would hit, and therefore we would be financially independent. Now the number may be 5 times that amount and 10 times, etc. So it's never going to be enough. So independence, absolutely, try and get that early. But it's a precious life, do as much as you can. So why retire?
So no need to retire, but generate enough wealth for yourself so that you can take your own financial decisions, work if you want. If you don't want, you can do other things, right? Pursue your passions is what you're saying.
Right. So what we talked about earlier was that, having enough gives you that flexibility.
Correct.
What type of work do you want to spend your energy and time on? And that's important. So that's not retirement. That is, okay, I choose to do this. Now, what that is something that you have flexibility with. So that's something everyone should pursue.
But do you think the younger generation is prepared for retirement adequately?
I think the older generation is also not prepared for retirement, which is a big worry, because at least the younger generation has time. The elder generation doesn't have enough time. So we did a survey some time back, and it said that 90% of respondents felt that they should have started planning for their retirement earlier than they did. And I think about a third of them said that with what I have at retirement, I think it'll get over in 5-6 years. And definitely you're going to live longer than that in most average groups. So it's not going to be enough. And that's a larger problem today than for the younger generation. The younger generation, of course, should learn from those nearer retirement today and say, please don't make the same mistake. We have, as an economy, as a society, transitioned from defined benefit, which is where you collect pensions, which are defined, to defined contribution, which means you contribute for your own retirement, and there is no safety net. So you have to build it. And that's, I think, a large challenge for many who are nearing retirement or have just retired now.
So, if you could go back to the start of your career, right, what is the financial advice that you would give your younger self today?
Start as early as possible and don't get distracted on the way. So, stick a very simple, plan. At that point in time, I would just put most of your money into equity funds and forget about it. Had I done that, I would be a really, really rich man today.
What is your definition of rich?
Much more than what I have today. But so most of us, and that's a common challenge we see, that India has produced fabulous returns for investors. And so have funds. So you could have captured those returns through mutual funds that we offer. It's a very simple thing to do. Yet how many of us have actually seized that opportunity effectively? And in trying to go in, go out, in, time out, etc., have we not destroyed more value than created? So had you just put that money in and sat tight for 20, 25 years, the numbers are mind-boggling. And, in trying to do too many things, we are probably destroying, and, there's a term called activity bias. And, that bias of, I must react to every piece of news probably destroys more value than creates it.
Absolutely, absolutely. Analysis paralysis, right? That also. But how do you see your personal relationship evolving with wealth over the next, say, decade or so? Anything in your wealth creation journey that is still lacking, that's something that you'd want to work on?
So real estate, I still have to sort out because I've been completely, underweight that asset class, because I've always felt, especially living in Mumbai, that how do you justify these prices almost?
You're not alone. Every person I speak to tells me the same thing, that Mumbai is so unaffordable now.
Yeah.
I mean, how much ever you have, it's never enough, right?
Yeah, and for the quality you're getting, or the capital value versus quality, just the equation seems very, very odd.
But do you think real estate is a good option? I mean, in metros now, or is it too overpriced?
As an investment. Yeah, see, as an investment, I don't think you should look at it in that sense, because as an investment, once the tax benefit goes, will it outperform other forms? I'm not so sure. Now, you have to be in a micro market and be very active like a stock picker to be able to pick properties and sort of almost trade in and out with a very high transaction cost to be able to make money in that. And yeah, professionals can do it, but unless you're fully into it, I would say try and be more modest in what you can achieve there.
Okay, so everyone talks about sort of AI taking their jobs and AI getting into every industry, particularly for wealth management, right? How do you see the role of AI evolve?
So look, in the first phase, we saw that through better customer service, whether it's a chat bot or whether it is better access to your information. And then we saw that into statementing and performance management, which is, a smarter portfolio, a smarter way of seeing your money and now what you're seeing with Gen AI is a far higher level of customization as well as efficiency. So companies can now really do things much faster because of the power of Gen AI. Now it may have rough edges, which are still getting cleaned out. At Bandhan AMC, we actually took a leap almost 6-7 years back in 2017 when we said that we'll have an AI ML powered PMS that we offer. So a portfolio curated entirely by a machine learning program, and it's done very well. So that's the sort of incubation of how can AI ML get you to a far more superior portfolio. And that's a great area of build-up that we're seeing.
But then if that evolves further, where you have a lot of these AI/ML-led portfolio building,
right.
What happens to, the human bias? I mean, the fund managers and the wealth managers and all of that.
Yeah, so you have machines and you have artists. So you will still need the artists, and you will need a lot more of the alpha generation that, the fund managers can do.
Don't you think AI will be able to generate much more alpha just purely because of the way the system is designed?
Yes and no, because AI is dependent on the past. It's not looking forward. What it's predicting is recreating the past and saying this trend continues. When trends change, the machines fail. And trends keep changing. So I think that's where the human intelligence will still come in. So human, man plus machine to us is the combination we have to look at.
Nice. Okay. In terms of, you've spoken a lot about your own journey and your own wealth creation, learnings, right? What have some of the harsh lessons been that you've learned that you'd want to sort of pass on to the next generation?
So one of my early learnings was that you can have a big number against how much wealth you have, but unless you can access it, it's only a number. It is nothing. So early on in life, a friend's family needed a lot of money, and I thought they were so rich because they had ancestral property, and this was worth crores in those days, which is like these guys are really rich, khandani, and all of that. The fact is, when you need the money, if you can't write a check or you can't draw on that, what's it worth? So to me, liquid money, what can I get within a defined period of time, is the only way to measure wealth. And I think in looking at our investment decisions, we don't place as much value on liquidity as we should. So all investments are not equal if the liquidity that they offer is very different, or the cost that they offer is very different.
So that's why you're not so much in favor of real estate, and you believe that just owning one house in which you live is enough, right?
If you come across a great investment, not saying no, but it's not in itself something that I would be overweight on, because it's just so illiquid and so inefficient in many ways.
Vishal, thank you so much. It was a lovely conversation, and not just about money and mutual funds, but in general about how to approach life, right? When you go about with wealth creation, which is a really long journey for everyone. That wraps up our conversation with Vishal Kapoor. We hope you found today's episode insightful, whether it was Vishal's approach to risk management or his focus on bringing mutual funds to underserved regions. So if you enjoyed this episode of Get Real About Wealth, make sure you follow us so you don't miss out on more conversations with financial leaders and experts.